So guys, investing in the stock market can seem pretty scary if you've never done it before. I've definitely noticed this fear in my friends and family when I've tried to help them start investing, and I remember feeling this same way when I was first getting into it. But one of the cool things about investing in dividend stocks is that many of the companies that pay dividends are well-known household names. These are businesses whose products you probably use on a regular basis, which can make investing feel less intimidating, and I think can even make it exciting. With that said, in this video, we'll be taking a look at over 20 of these companies, 23 to be exact. I guarantee you'll be familiar with most of them. And they're all great ones to consider if you're just getting started with investing and are looking for some recognizable companies to add to your portfolio. Now, like I mentioned, many of the great dividend-paying companies are well-known household names, and that's where we're going to start. I'm sure that somewhere around your house you have things like Crest toothpaste, Tide laundry detergent, Clorox bleach, and Band-Aids. Well, those are all made by these three dividend-paying companies here. We have Procter & Gamble, Clorox, and Kenvue, which out of the three, maybe the only company you're not familiar with, but Kenvue spun off from Johnson & Johnson in the healthcare sector not too long ago. And their portfolio consists of products you would definitely recognize like Tylenol, Band-Aid, Neutrogena, and Listerine. Now, comparing the dividend stats across these three companies here, we can see right off the bat that Kenvue has the highest starting yield at almost 4%, so that's a very high yield. But this company has no dividend growth history since they are a recent spinoff, so they just haven't had the time to develop that yet. And out of the three, Procter & Gamble has the lowest starting yield at 2.5%, but they have the highest dividend growth rate or dividend growth CAGR at 6.2%. And basically what this number represents, the CAGR, is the compound annual growth rate of the dividend. So on average over the last 5 years, Procter & Gamble has increased their dividend by an average rate of about 6%. And in addition to having the highest dividend growth rate, Procter & Gamble also has the highest dividend growth history at 68 years, which makes them what we refer to as a dividend king. And a dividend king is a company who has made consistent increases to their dividend for at least 50 consecutive years. So Procter & Gamble's done that and then some, and we can see Clorox is really not too far off from being a dividend king. They also have a very respectable dividend growth history of 47 years. And out of the bunch here, while I think all of these are fine companies to own, definitely very safe companies to have in your portfolio, Procter & Gamble is the only one that I personally have in my portfolio. Taking a look at my Procter & Gamble position, this is a pretty middle of the road position for me. I have about 28 shares at an average cost of $139.20, so I'm doing pretty well with this position. I'm up 16% just in terms of share price, and including dividends, I'm up over 22%. And like I said, this is pretty moderate in terms of position size. It only makes up about 5.25% of my total portfolio. And by the way, guys, what we were just looking at was from Snowball Analytics, which is hands down one of my favorite portfolio trackers out there. This platform is a beast. And if you're looking for something with more bells and whistles than your standard spreadsheet, I think this is the one that you need to check out. And the cool thing is you can actually try out Snowball Analytics for free. In the description and in the pinned comment, there's a link to a 14-day free trial, so you can try out Snowball Analytics risk-free. I highly recommend you check it out. I know you guys are going to like it. But anyway, back to Procter & Gamble. I just think this company has the most diverse and essential lineup of products. You know, they make things that people need to buy no matter what's going on, like toothpaste, laundry detergent, deodorant, diapers, paper towels, toilet paper, and so much more. And all of their brands really are the cream of the crop. Overall, in my opinion, it doesn't get much more dependable than Procter & Gamble, and that's why I think it's such a great investment to consider for not only brand new investors, but really any investor looking for some stability and dependability in their portfolio. But anyway, guys, now moving on to our next category of companies. This is food and beverage, and you'll recognize all of these companies. At the top there, we have Coca-Cola, ticker symbol KO. Then we have Pepsi. Then we have the Hershey Company, all three very iconic companies. And then number 4 there is a company called Mondelez, which owns brands like Chips Ahoy, Honey Maid graham crackers, Wheat Thins, love Wheat Thins, Triscuits, love Triscuits as well, Ritz crackers, and my personal favorite, Oreo cookies. You can't beat Oreos. Anyway, guys, comparing the dividend stats across these 4 companies, right off the bat, we can see that the yields are all very similar, all kind of moderate 3% range, but in the dividend growth department, this is where we start to see some variance across these companies. Out of the 4, Coca-Cola has the lowest dividend growth rate, just below 4%, and they also have one of the lowest starting yields out of the group at 3.2%, but they have the longest dividend growth history at 62 years. And on the other hand, the Hershey Company and Mondelez have the lowest dividend growth histories, you know, in the teens there, definitely not as long as Coca-Cola or Pepsi, but these 2 companies have the highest dividend growth rates, both over double digits, about 13% for Hershey and 10.5% for Mondelez, which brings up an important point. While it's cool to find these dividend kings with extensive dividend growth histories, you know, it's cool to know that they are that dedicated and consistent with their dividend. At the same time, you shouldn't buy a stock just because it's a dividend king. In fact, you shouldn't buy a stock just because of any of its dividend stats. You have to look at the big picture. But specifically as it pertains to the dividend growth history, like I said, it's good to know that they've been able to make those consistent increases for that long. But I do think there are more important things to look at when it comes to the dividend stats. For example, even though Coca-Cola has the longest dividend growth history, I'd personally rather own any of the other three here because there seems to be more growth in the dividend department. And over the long run, that's what's going to make a big difference for your portfolio. Not the dividend growth history, but the dividend growth rate. And with that, if I had to narrow it down to just one of these companies to own, I'd honestly probably go with Pepsi. Similar to Procter & Gamble, Pepsi has the widest product mix that stretches far beyond just their namesake soda. They also own a ton of other beverages like Mountain Dew and Gatorade, and a lot of people don't know this, but they also own all of Frito-Lay. So they own Lay's, Doritos, Cheetos, Fritos, Tostitos, Funyuns, Miss Vicky's, and all of these other brands here. Still though, I think they're all worth looking into, and right now may not be a bad time to really consider stocks like Pepsi, the Hershey Company, and Mondelez because all of their share prices have really taken a hit. Now is not a bad time to buy the dip on any of those three. Taking a look at Pepsi's share price performance over here on Snapstock, which is a stock analysis platform that I've been developing, and you can get access to it when you become a member of the investment club. If you want to learn more about that, there's a link to it in the description of the video. I hope you check it out. But here we can see that just in the last month, Pepsi is down 8.3%. That is a very big drop. And if we zoom out over the last year, Pepsi's down about 10%. So they've really taken a hit. Now jumping over to the Hershey Company, they've seen an even bigger drop in the last 30 days. The stock is down 13.25%, a huge drop. Definitely a big dip for the Hershey Company. If we zoom out over the last year, the stock is down 14.2%. So most of their losses in the last year have pretty much come just in the last 30 days. And then taking a look at Mondelez, their share price drop has been the most tame out of the three in the last 30 days. The stock is only down 4.2%. But if we zoom out over the last year, this company has seen the biggest drop out of the bunch. The stock is down 19%. So definitely a good time to buy the dip. Anyway, moving on, guys. So far, we've pretty much only been talking about different consumer-facing products. But this next category of companies are places that you would go to buy these products. We're talking about grocery stores. And on this list, I've got 4 really solid choices for you guys. We have Costco there right at the top. You guys definitely know that one. Kroger, you'll be familiar with that. Walmart, of course, and we also have Target. How could you not know Target? And comparing the dividend stats across all 4 of these companies, the yields and the growth rates are all over the place. Out of the bunch, Costco's gonna have the lowest starting yield at only 0.5%, but with that, they have a really nice dividend growth rate of over 12%, which I think makes up for that low starting yield, and they have a pretty decent dividend growth history of 20 years. In fact, I think the growth history on all these companies is pretty fine. Kroger has the lowest growth history, but 17 years, definitely not going to complain about that. And Kroger's stats across the board, I think, are looking really good. A nice 2% yield, a killer 15% 5-year growth rate as well. That one's the best out of the bunch. And then we have Walmart. You know, pretty low starting yield here, less than 1%, and a very low dividend growth rate to match, only 3%. So if I was you, I wouldn't be buying Walmart just for the dividend. But, you know, like we said earlier, guys, you shouldn't buy a stock because of any of the dividend stats. You have to look at the big picture. Now, truth be told, I don't think you can go wrong with any of these companies. I think they're all pretty great, pretty safe companies to own. But Costco would be at the top of my list if I had to pick just one. You know, Costco's membership revenue is a huge competitive advantage for this company that they have over their other competitors. And as we can see, this has helped them generate really solid and really consistent growth in the financials over the years, from top to bottom. And that's likely to continue as time goes on. Now, the one downside to Costco is that because it is such a beast of a company and everyone knows it, it pretty much always trades at a pretty lofty valuation. Costco's pretty much one of those stocks that only seems to go up. And if we look at the last year, as opposed to the other stocks that we looked at a few moments ago, Costco has had a really great year. The stock outperformed the S&P 500 in 2024 and was up 39.3%. So if you're looking for any sort of discernible discount, I don't think you'll find it with Costco at the moment. But with that, if you had a pretty long time horizon, you know, if you plan to use your investments maybe 15, 20, 25 years down the road, I still think you'd probably fare pretty well, even if you bought Costco at these pretty high prices. I don't think you'd be disappointed with the end result, you know, if you were able to hold on to it for the next 20 years. But anyway, guys, now these next 3 companies that we're talking about, I know you'll be familiar with. These are some of the world's most popular quick service restaurants. We're talking about McDonald's, Starbucks, and Yum Brands, which owns KFC, Taco Bell, Pizza Hut, and the Habit Burger. And just comparing the dividend stats, there's really not a whole lot of variance across these three companies. The yields are all in a pretty similar range, low to mid 2%. The dividend growth rates are all same thing, high single digits. And really, all three of these are solid dividend paying companies. You can't go wrong with McDonald's, and I don't think you can go wrong with Yum Brands or Starbucks either. But out of the three, Starbucks is the only one that I personally own, and it's actually one of the largest positions in my portfolio. Behind SHD and Visa, Starbucks is my third largest overall position. And as we can see, I have just over 78 shares at an average cost of $86.34. So in terms of share price, I'm up about 7%. Dividends give me a little extra boost there. And at this point in time, Starbucks makes up about 8.4% of my total portfolio. But anyway, moving on, guys, these next two companies are pretty much the only two big players in the home improvement space. You'll definitely know these companies. We're talking about Home Depot and Lowe's. And these two companies pretty much operate in a duopoly, which means that their only real competition is with each other. And there's certainly more than enough room for both to exist at the same time. Now, comparing the dividend stats, it's pretty close here. There is a bit of a trade-off. While Home Depot has the slightly higher yield by 0.5%, they do have the lower dividend growth rate at 10.6%, which is still good. But personally speaking, I would rather take Lowe's lower starting yield at 1.8% if it means I get the higher dividend growth rate at 17%. I think that's a much bigger deal. And also, not that it matters all too much, but Lowe's is a dividend king with 61 straight years of growth. And in my portfolio, I actually do own a little bit of Lowe's, guys. I have 16.4 shares at an average cost that I think is very sweet, $194.50. So right now I'm up about 26.4% in terms of share price. I'm up over 31%, including dividends. And Lowe's is a pretty middle of the road position for me. It used to make up a larger percentage of my portfolio, but I haven't picked up any shares for a long time because it's quite a bit above my cost basis. So for now, it's making up about 4.7% of the portfolio. And then, guys, jumping over to this next category of companies, we're going to look at the technology sector. We're going to take a look at 4 of the world's largest companies. On this list, you guys will know all of these companies. We have Apple, Microsoft, Alphabet or Google, and then Meta. And believe it or not, guys, all 4 of these companies do pay a dividend, albeit not a large one. All of them have yields less than 1%. And because of that, many investors don't consider these companies to be dividend stocks. They think that the starting yield is too low to be categorized as such. But I don't personally agree with that. These stocks pay a dividend, and so in my mind, they're dividend stocks. Now, as we can see here, going back to these dividend stats, Google and Meta don't have dividend growth histories yet because they only recently started paying dividends. So we'll have to wait and see what that ends up looking like. But I think both of those companies have all of the makings to be fantastic dividend growth stocks moving forward. Back over here on Snapstock, if we look at Google's growth metrics from top to bottom, this company is just a growth machine. Killer sales growth, killer growth in the earnings per share, and also really awesome free cash flow per share growth, which is definitely going to bode well for the dividend. And all of these 5-year growth rates are in the double digits, 17.4% for the revenue, about 24% for the earnings per share. That's fantastic. And the free cash flow per share is growing at the fastest rate out of the 3 at over 25% on average over these last 5 years. And with that substantial growth in the financials, especially the free cash flow per share, I would be very surprised if we didn't see Alphabet throwing out some definitely double-digit dividend increases here in the near future, but I'd be surprised if we didn't see them throwing out dividend increases over 20%. We'll see what happens, but that's kind of what I'm thinking based on these financials. And now jumping over here to Meta, what we're seeing in the growth department here is actually pretty identical to Alphabet, and the 5-year growth rates are all pretty comparable as well, which is a great sign. All in all, I don't think you can go wrong with any of these companies. They're all growth monsters and great companies to own, not unlike these next 3 stocks, which are going to come from the payment technology industry. They're kind of technology companies, they're kind of financial companies. I think they kind of double dip into both sectors, but we have Visa, MasterCard, and American Express. And when it comes to these companies, because they're all very similar companies, I get asked all the time, which one should I own? If I had to pick just one out of the 3, which one's the best? And just taking a look at the dividend stats, I mean, I don't think you can go wrong with any of these 3. They're all pretty similar. And operationally too, they're all very similar businesses. Visa, MasterCard, and American Express, these are all payment networks, which means that whenever you make a purchase using your credit or debit card card, they are involved with facilitating that transfer of funds. Out of the three, though, Visa is the largest payment network by far. They handle more transactions than the other two by a long shot. With that, though, American Express is a bit different than the other two in the sense that they also issue credit cards. Visa and MasterCard don't do that. They're just a payment network, and so the credit or debit card is issued by your bank. For American Express, the fact that they issue credit can be both a good and a bad thing. It's good because it offers them an initial revenue source in the form of interest income, but on the other hand, they're also on the hook for any of their customers' outstanding credit card debt. So it does add an extra layer of risk that Visa and MasterCard don't have. Now, personally speaking, out of the three, Visa is the only one that I have in my portfolio, and it's actually one of my largest positions. And I'm telling you more about that in this next video right over here, where I'm sharing with you the top 5 largest holdings in my portfolio, and I'll also share with you how much they each pay me in dividends every year. So click right over here to learn more about that, and I'll see you in the next one.